Thank you for tuning in to this tutorial for the Black Ops Trading Room. Today we're going to talk about stop losses, trailing stop losses, how to do what it is that you need to do. All right, each broker that you work with is going to be different. So for the sake of this video, we're using Thinkorswim by TD Ameritrade. It should be noted that there are several different types of order types. Order types can get very complex, but for the sake of this video, we're only sticking to the basics. You have the benefit of someone as myself who actually used to run a trade desk when I did my Wall Street thing, okay? So I ran the trade desk. So order types can make or break your bottom line. One of the biggest problems that traders have is execution. Order execution is paramount. You're going to need to be able to execute your strategy. If you can't execute your strategy, it doesn't matter how effective the technique or strategy is. If you can't execute it properly, then nothing else matters. Okay? There are simple steps that you can use and that you can take to assure yourself that you're going to succeed in your trade. All right, so first of all, the first type of an order is called a market order. Understand that with market orders are executed immediately in the market. Let's take a look at what some of that looks like for the most part. All right, in this screen here, we're using ticker symbol HACK. We'll do analysis videos at another video, but just want to point out, you see how it's moving higher just as the system told you that it would back when it was down here. Okay, so you see here the bid and the ask. Okay, here if you're going to sell this, it's at 26, and on the buy side it's at 27.65. So that's $1.65 spread. If you were to place a market order, you could be filled anywhere within that spread. Typically, if you're going to buy it at a market, you'll be filled at this price here. If you're going to sell it at the market, you could be filled at this price here. Let's take a look at what that means. Say for instance you went ahead and you pressed the sell button to sell it at market, and you're filled short at $26 a share. Currently the market is trading here at $27.64, so you would be down automatically $1.65 right off the bat, which is the difference between the spread here. Does that make sense? So that's the way that usually works. Okay, usually on the green side is your buy side. That's pretty much the difference between the bid and the ask is the spread in the market, and you could be filled anywhere within that range when you hit a market order. It should also be noted that when you place market orders in what is called fast markets, crazy things can happen. You can get outrageous fills. If you're placing a buy order, you could be filled at the high of the day, only to see the market swing and be trading at the low of the session. If you place a sell order, you could be filled at the low of the day, only to see the market rallying to new highs. Those are fast market conditions. Likewise, in more thinly traded markets, especially in commodity markets, you can find yourself in a situation where you're not even getting a fill at all. Under fast market rules, you are not guaranteed a fill at all. It's basically trade at your own risk when you're using a market order. So market orders are best reserved for extremely liquid markets. When we're talking about stocks, we're talking, shares over, 10 million shares. That's liquidity. 5 million shares for a stock is like nothing. All right, that's considered illiquid. You want something that's, more than 10 million shares, and preferably the more shares the better. If something's trading at 40, 50 million, 100 million shares, that's a very liquid market. All right, so that's just something to keep in mind. All right, let's move on to our next example, talking about limit orders. All right, excuse me. A limit order basically is saying I want to be filled at X price or better. When you're buying in the market and you place a buy limit order, typically what you're saying is you're going to want to time it, because the way the system is going to read that limit order is going to determine how that order is executed or even rejected based on what broker you're using. So let's using our hack example. Currently, you see the market is trading at $27.64 a share. If I put a buy limit order in it, let's say I want to buy it at $26 or better, well, you can see the market is $1.64 higher than that, right? So that limit order would set there and work either as a day order or a GTC, which is a good till canceled order. You have to specify to the system what type of an order you're placing. It should be noted that on market orders, all market orders are day orders only. You cannot place a good till canceled market order. Market orders are filled immediately. They're considered day orders. If you place it as a good till cancel, it's not going to listen to you. It's going to reject the order, or it may even just execute it anyway, immediately. All right, so keep that in the back of your mind. Back to the limit order. So if you place a limit order below the market, it's going to sit there and work and wait till the market pulls back, and then it'll fill you. Okay. If you place a buy limit order above the market, it's going to fill you wherever the market is currently trading at. All right. So let's say the market is trading at 27.64, which it is, and I place a limit order to buy hack at $28 or better. That's what a limit order says. A buy limit says buy it at this specified price or better. Better is always lower. So if I say buy me hack X amount of shares at $28 a share, where currently the market's trading at $27.64 a share, so what will happen? I will be filled at the $27.64 because that's better than $28, and the market is not trading at $28. Likewise, if I place a sell limit order to sell the market at $28 or better, in the same example, using the same example, that order is not going to fill. It's going to sit there until it gets to $28. Buy limit orders are supposed to be placed below the market. Sell limit orders are supposed to be placed above the market. So let's break that down further. When you're using a buy limit order, you're saying I want to buy a pullback in a particular market. So whatever the price is, I want to buy lower. On a sell limit order, you're saying I want to buy higher than where the market is. All right, or better, above my price. So you have to place it above the market. So in the same example, market's at 27.64. I need to place my sell limit at 27.65 or higher. If that, you see what I'm saying, it has to be above the market. If you place it below the market, if I was to place a sell limit right now at 27, let's say I place a sell limit at $27 right now, it would execute me immediately and fill me at 27.64 because 27.64 is better than the price I said at 27. So the way to think about limit orders is my price or better. When you're buying, it's my price or lower. When you're selling, it's my price or higher. So sell limits need to be placed above the market. Buy limits need to be placed below the market. You got that? All right. Let's move on to our stop orders. A buy stop, or a sell stop becomes a market order once your price is hit. So using our same example here, if I were to place a buy stop order right now, buy me at $26 on a stop. I'm telling the computer I want it to buy me at once the market trades up to $26, I want to get in the market. Well, it's already at 27.64. So either the computer is going to reject that order and say the market's already higher than that, please put in a price above the market, or it just may go ahead and execute me immediately. All right, and turn it into a market order. Depends on your broker, depends on the software you're using. But just like the limit order, the stop order is like a limit order in reverse. Now, in our example for buy limits, we need to buy below the market. So if the market's at $27.64, my buy limit needs to be any price below this current price, correct? A buy stop is different. A buy stop order needs to be placed above the market. So remember what we use when we're doing something above the market. Remember, the sell limit is placed above the market. Well, so is the buy stop. The stop orders are like the limit orders in reverse. Okay, so if I'm going to buy hack on a stop, I want to place my stop above the market. I can place it anywhere above the market I want. I can say buy it when it hits 28, buy it when it hits 29, buy it when it hits 27.65. You get the point. A sell stop is below the market, so I can place my sell stop anywhere below 27.64. I can put it 27.63, 62. I can say 26, 25, 24, 23. If it hits this, sell it. That's what a stop does. But keep in mind, a stop order becomes a market order once the market trades and touches that price. Just like with a limit order, once the market touches that price, your limit order is going to work and try to fill you at your price or better. A stop order is not going to work like that. A stop order is going to trigger the trade and then fill it at the market. Now, let's look at some of the nuances of the limit and the stop. On a limit order, what can happen is the market can trade at your price, but you're not guaranteed to fill. A stop order, on the other hand, once the market trades at your price, it does guarantee you a fill. How is that? Well, because a limit order does not become a market order once the market trades at your price. With a limit order, once the market trades at your price, it must fill you at your price or better. If it's a buy limit, it's your price or lower. If it's a sell limit, it's your price or higher. On the stop order, it becomes a market order, so it must fill you. All right, whatever the range is. With limits, it doesn't guarantee you a fill. Now, the reason why I changed the screens here is to show you an example of that. You probably can't quite see it here, so let's see if I can make this larger and move this around a little bit. Okay, maybe this will help you see it a little bit better. Okay, this here is your market depth. It's showing you the price ladder, and then off to the left and the right is your asks and your bids. Ask is here's how much they're asking for selling. Bid is how much they're bidding to buy it. Over to the far left is your volume around these orders and prices. As you can see right now, this is pretty liquid. You don't see too much depth in this, and that's because the market is closed. All right, at the time I'm doing this video, it's after 4:00 p.m. Eastern Standard Time, Thursday, September the 22nd, 2016. But it's still, for the sake of our understanding here, I just want you to see this. So for example, here on this volume at this price, 27.64, you have 49,054 orders there. I do believe the volume is in thousands, because yeah, the orders in thousands, because I'm looking at today's volume, and yeah, this is in thousands. So depending on where you are in this ladder for price and time of sales and all that will determine where you're going to be filled, if at all, at that particular price. So in other words, whoever puts their order in first is going to get filled first when their limit is hit at this price. It's a possibility that it could touch the price and not fill you. It could touch it and then pull back. If it hits 27.64 and pulls back to 27.63 and stays there for a minute, you're not going to get filled, because that's not your price, 64 or better on a sell. It has to be higher. We're talking about the sell limit right now. You understand what I'm saying? On the buy side though, if it hits 27.64, which is your buy limit, and then pulls back to 63, if it doesn't fill you at 64 because all these people were here ahead of you, then you have a higher chance of getting it filled at 63, especially depends on how long it stays there and trades there. Does that make sense? Has to clear out these orders before it can, before you get a fill. So it's like a first in, first out kind of thing. So that's why limit order is a little bit trickier, because it doesn't guarantee you a better fill, but you can pretty much get a fill at your price depending on the liquidities of markets. I have seen it where markets can jump and skip all over the place, and then your limit is just there looking lonely. Example would be if the market were, let's say you have a buy limit at 27.64 and you placed it when the market was at 65. The market can pull back to 64, but doesn't stay there long enough to clear out all these tickets, and let's say you're the last one, you're the 49,054th order. All right, it could stay here for a minute, clear out maybe 49,000 of that, leave 54 of you hanging, and then it can jump up to 65 and keep running, and then it can run without you. That is a possibility. That is the danger, or the downside of limit orders. It doesn't guarantee you a fill, is what I'm trying to say. A stop would have. If you placed a stop at 27.64 and the market was trading at 27.60 when it happened, it could hit this right here and even blow past it, or it could say, all right, trade is at 27.60, then the next trade could be at 27.68. Your stop was at 64. It's going to fill you that 68 or whatever the range is once it gapped above that price. All right. So limits protect you from slippage in that situation. You had your sell limit in here when the market was here. All right. You had it here or here. It came here and then it kept going, or it could pull back. So if it doesn't fill you at your price or better, which is lower, then you're not in the trade when it jumps and skips. So it kind of leaves you in the dust. But on a gap, let's say you put your buy limit in as a good till canceled order right below the market, right at the close, and then tomorrow morning the market goes from here where it closed and opens up here. It's not going to fill you unless it pulls back to you. If it keeps running, you're not in the trade, so you don't experience this slippage here, which is the difference between your limit order and where the market gapped up the next day. On the other hand, if you're using a buy stop order, and let's say the market was here, you placed your buy stop here right before the close, then tomorrow we gap and open up here, the market's going to fill you wherever the opening range is for like the first 5 minutes of trading. So if the market gaps up $1 or $5, it's going to fill you up there. So, and let's say after it fills, after it gaps up $5 and then rallies $15 more throughout the day, you're going to experience all that rally. Yeah, it gapped and took you with it though. The limit order guy is down here crying because now he didn't get filled and he missed out on that opportunity. So limit orders can protect you in certain situations, but I like using stops. All right, stops don't guarantee that you're going to get filled at your price though. You can be slipped, markets can gap up or down, but that's kind of the trade-off. Another order type is the stop limit order. A stop limit order is a stop and a limit combined. The way that is executed, let me see if I can show it to you. Okay, looking here at the bottom of your screen, Thinkorswim automatically defaults to limit orders, and you can set it to the set amount of shares for stocks, whatever you want to do. So I just wanted to show you what it looks like. You're going to have a buy side and a sell side. Now let's go over here to the far right hand side. I want to show you something real quick. Okay. It automatically defaults to limit order. Not too much you can do about that. So you're going to have to change it. So let me show you what a stop limit will look like. You come over here and you hit stop limit. See the drop down menu, market, limit, stop, stop, limit, trailing stop, blah, blah, blah. Market on close, LOC. I can't remember what LOC is. Limit on close, that's right. Market on close and limit on close. Okay, so yeah, going back here. Okay, so you're going to hit stop limit, and then it changes the screen. All right, here's how this works. See this section right here? STP is stop, and here's your limit. So in this example, the market closed at 27.64, right? So let's say we want to put ours at 27.65, and we'll give ourselves a nickel of slippage. All right, we'll say 70 here. Okay, so here's how this works. As you can see, here's our stop loss is at the bottom, and it's red. Okay, it's a sell stop, because when you buy something, the only way to offset it is to sell something, right? So here's our stop loss at $26.40. All right, here it goes. 27.65 on a stop, 27.70 limit. Here's how this order works. This order is a stop order with a limit attached to protect you in gapping situations. Okay. So tomorrow morning, all right, you see we closed at 27.64 today. So tomorrow morning, if this market, let's say it opens where it closed at 27.64, and it proceeds to fall from there. Let's say 27.64 is where it opens, and that's the high, and then it collapses $2, $3, $4 tomorrow. Well, guess what? You're not going to be in the trade because your stop was at 27.65. It needs to trade at 27.65 before it triggers this order. So let's say tomorrow it opens at 27.64, and then it rallies $4 or $5 throughout the day. Well, what happened is once it hits 27.65, it triggers this stop. And instead of this stop becoming a market order, remember stops become market orders once the price is touched. This is going to still become a market order per se, but within a limit. All right, meaning that it can only trade at the 27.65 and 27.70 range. Okay, that's it. It can't slip you more than what you tell it in the limit. You could have put this limit anywhere you wanted. You could have said 27.65 stop on a $30 limit and say $30 at the top. All right, giving yourself several dollars of room. It's up to you. I normally do like 5 cents. So anyway, that's pretty much how this works. Okay. Now, in some cases, it could trigger the 27.65 and then fall at that point. You will be filled again at the range as a market order within that range, but you'll be filled no worse than 27.70. But you can actually be filled lower also. So just keep that in mind. Those are our lessons for the day, and stops and stop limits. And the next installment we'll do how to trail positions.